Fixed or variable mortgage. It's not as complicated as you think. Welcome to Mocktail Minute with the Acadian Realtor, where I answer common questions I get from buyers and sellers in the simplest way possible. Here is this week's question. Chin chin. How are fixed and variable mortgage rates calculated? A fixed rate means your interest rate and your payments stay the same the whole time. They're based on what they call bond yields. What are bond yields? A bond is money investors lend to, for instance, the government or a corporation. And the bond yield is the interest rate an investor earns on that bond. And that rate is based on what investors think is coming with inflation and the economy. So that's why fixed rates can change even when the Bank of Canada doesn't. A fixed is great if you like consistency and knowing exactly what your payment will be. Now, a variable rate can move up or down. It's tied to the Bank of Canada's overnight rate. The overnight rate is what banks use to lend money to each other short term. So when that overnight rate changes, banks usually adjust their prime rate. And the prime is basically the base rate banks use for variable mortgages. And that moves up or down when the Bank of Canada changes its rate. The important thing to know, fixed and variable don't move for the same reasons. So one can go up while the other goes down. And if you're thinking, okay, well, which one is best for me? Well, that's where I would suggest you speak to a mortgage professional. I work with trusted mortgage pros, and I can connect you with one who'll break it all down for you and for your situation. Just send me a message. If you have a real estate question, drop it in the comments, and I'll cover it in an upcoming Mocktail Minute. Cheers.